Hello and welcome to my presentation on how to manage debt and create a balance sheet. Let's firstly look into debt. For debt, there are three critical factors to consider when deciding how much debt to incur. And the first one should be the amount of debt should be enough to cover those goals you're trying to achieve. The third one is that the debt's interest rate should be as low as possible so that you can repay it in a realistic time frame in incremental payments. And then thirdly, it's not a bad idea to do a break even analysis on how much debt you'd probably need to break even. Let's look at a balance sheet. So, why is a balance sheet important and what is it? So, the purpose of a balance sheet is to correctly account for all the transactions that occurred during a time period. It's a snapshot of your business's financial position in that given day or that time, and it's usually calculated at the end of a quarter or year. Elements that are included into a balance sheet are assets such as accounts receivable, the people that owe you money, reimbursable expenses, inventory, or equipment that you've purchased that is of value. Liabilities are people that you owe money, accounts payable, credit cards, or taxes. And then equity are investments that you receive for the company, contributions, owner's capital, or previous earnings from a previous time period. Let's see this in action. Right here, I am showing you the balance sheet section that is highlighted over here. And you can see on the left-hand side, it's broken down into assets, which include the cash. And I'll talk about the cash because the cash will show us how much cash we've got at hand for for all of these transactions. Let's leave cash out for now. In the assets, like I mentioned, accounts receivable, inventory, equipment, and a depreciation on that, which gives us total assets. Liabilities, like the accounts payable, who we owe money, or loans, and then owner's equity, which is paid in capital or earnings or owner's withdrawal. Now, to calculate all of this and see how we balance it out, we would take the total sum of all the assets, okay, as it currently stands, and we would subtract from that the total liabilities and the total equity. Now, here's the total liabilities and the total equity. And if I subtract that from this amount over here, I'm going to get a difference of 1482. And that difference is the actual cash that I've got left. And if you look in here, and if I go and add in that difference of 1482.80, it will actually show me that this balances out now. So from all of this cash over here that we've got, all of these assets minus all of these, this will show us our transactions actually balance out. I go to February and I do the same and I put in 403.49. That will also balance out. And there you can see that's how a balance sheet works from a very high level point of view. Thank you for watching. Hope you've learned something.